Joining us today on Wall Street Silver is the legendary investor, speculator, and former CEO of Sprott, Rick Rule. How's the day going today, Rick?
Today is absolutely wonderful. I'm delighted to say that I received in the mail a couple days ago this piece of propaganda from you all. I had mentioned the last time that you interviewed me what joy I saw having Wall Street Silver pasted up in downtown Anacortes, Washington, the little town where I live. Unfortunately, some local sort of pinkos pasted over it with their own advertisement. So I think that what we're doing is we're going into a graffiti war, which I'm determined to win.
Hey, was it an ad for fiat currency?
It was just a gathering for some sort of group of fuzzy wuzzies who were determined to reduce my individual liberty. I forget what their particular cause was, other than I perceived it to be both anti-Rick and impolite that they put it right over you all's piece.
All right, we'll get them. We'll get them. We will win this war.
In a recent interview, you said that the Fed is sending wrong signals to society. Can you explain, Rick?
Sure. In a free market, interest rates normally exceed the rate of the depreciation of the currency. It doesn't make any sense that you would have to pay somebody to lend to them. That's not normal and natural. The idea that a lender would have to take the credit risk and then pay the borrower to consume now, while the lender forestalled his or her enjoyment of the fruits of their labor, is silly. So the most important misdirection that the Fed is sending society involves the cost of capital and the return on capital employed. This makes sense in a sociological context or a political context. One of the functions of a democracy, I think, unfortunately, is to assist spenders in their war on savers, spenders being numerous, savers being scarce. In a democracy, it makes perfect sense that those in power would facilitate the spenders relative to the savers. But it does send a bad message to society. You never increase the prosperity of a group of people by encouraging them to consume more than they produce. And that's precisely what the Fed is causing to occur.
Rick, would you add to that they're also causing people to just speculate in the markets, just trying to get yield and not be savers? And
absolutely true. For a substantial part of my life, you invested in bonds, in debt instruments for yield, and you invested in equity instruments for growth. Now, very often, the equity instruments yield more than the bonds, and people are buying equity instruments for the yield, and they're buying bonds in the hope that the Fed lowers the interest rate again and they can enjoy some capital gains. The disposition of capital, if that's the right word, has been really, really seriously altered by these interest rates signals. Similarly, the Fed, I think, has deliberately caused investors and savers and voters to misunderstand two different words in English. One being liquidity, which we have lots of, and the other being solvency, which we have none of. And I think that investors increasingly are substituting in their own minds liquidity for solvency. And I don't think that has a happy ending. If I could illustrate, if one of your listeners made, I don't know, $60,000, $70,000, $80,000 a year, sort of, middle income, owned a house that had appreciated well over the last few years and did as many people did, borrowed against the house, and let's say now they have an $800,000 or $900,000 mortgage, which probably becomes unserviceable at their income level. But they have $10,000 in their pocket. They have $10,000 worth of liquidity. They can buy beer. They can take their family to Disneyland, but they're in some danger of becoming homeless. This person is liquid, but this person is not solvent. Mm-hmm. And the actions of the Fed have caused investors and savers around the world to confuse liquidity with solvency.
Rick, I'm going to share 10-year Treasury yield. And I wanted to ask you about nominal and real interest rates. So the 10 years yield has fallen from about 1.7 couple, 2 or 3 months ago down to 1.2 now. And have you been surprised that gold and silver have not really responded to this dramatic drop in the yield on the 10-year?
In my experience, historically, the response has lagged.
Mhm.
That makes perfect sense. I think ultimately it will respond. I'll just say that. I think that if you look, a little further back, what you'll see is a pretty interesting overlay between the decline in the yield on the U.S. 10-year Treasury and the price of precious metals.
Mhm.
So I suspect it's going to be a lagging indicator.
How understated do you think CPI is for what real inflation is right now? How bad is the discrepancy?
Sadly, the answer to that is I don't know. I'm neither an economist, or a statistician. Obviously, the people from Shadow Stats have done a relatively good job of talking about inflation using the measurement metrics that existed 40 years ago in 1980. The truth is, I don't think the big thinkers know either. I don't think that I'm alone in my ignorance. I think that the people who set policy have no real idea what the cost of living is. I think, however, after 40 years, 40 of the most benign years in economic history, that people tend to underestimate the perniciousness of inflation. Let me give you a couple numbers. Nobody seems to be particularly concerned about 4.5% compound deterioration of the dollar. If you happen to be a saver, what that means is that over the next 5 years, 40% of your purchasing power goes to purchasing power heaven.
Mhm.
It doesn't happen in 3 months. It doesn't happen in 4 months. But unless you think your life expectancy is restricted to 2021, the idea that you don't have to worry demonstrates sort of a charming naivete, I guess. Putting that arithmetic in narrative form that I think your older listeners will respond to. When I was a young man, there was a business in the United States called Motel 6. Many of your listeners don't know that the reason it's called Motel 6 is because when I was a young man, a room there cost $6.
Wow.
Whoa.
In my young adulthood, when saving wasn't an option, when it was imperative, I had more than one occasion to stay at Motel 6 and pay $6. I was driving by a Motel 6 in Northwest Washington about a week ago, and the sign said Motel 6, $69.95. Now they hadn't changed the headline. They hadn't changed the headline to Motel 70. And the thing that your listeners need to confront with regards to this is that over 40 years, the price of a motel room at Motel 6 has gone from $6 to $70. Now, there's only two explanations for this. One, a room at Motel 6 may be 12 times the size as it was 40 years ago. It may have silk sheets. It may have 12 times the quality, given that the Fed does hedonistic adjustments to the CPI rate. Or the purchasing power of the medium used to purchase a room at Motel 6 could have declined over 40 years by 90%. I'll leave it to your listeners. I have to admit that I haven't done in recent years due diligence on rooms at Motel 6, so I don't know anything really about their size or their internal comportment. But my suggestion is it's more likely than not that the cause in the differential for a room at Motel 6 going from $6 to $70 has everything to do with the depreciation of the purchasing power of the dollar and not very much to do with the quality of a room at Motel 6.
Gotcha.
And I think that's really important for people to understand. People are beginning to be trained, first of all, to expect that the economy just goes from better to better after 40 years of an extraordinary economy. And people are also increasingly short-term oriented. What your listeners need to understand is that assuming that they intend to live for the next 5 years, even moderate inflation, 4.5% inflation, is really, really, really hard on their purchasing power.
Mhm.
And if you take it out over decades, which your younger listeners need to do, although they haven't been skilled in that yet, the problem becomes much more extraordinary. We believe that we haven't experienced inflation since the latter part of the decade, the early part of the decade of the 1980s. But the truth is, as measured as an example by the price of a room at Motel 6, we in fact have.
Rick, do you think people are getting the sense or the feel for inflation just going to the grocery store nowadays, seeing shrinkflation, going to the gas pump, seeing the price of gas up there like crazy? Do you think the average person's getting more of a sense of inflation these days?
I mean, it might be that I travel in the same circles that you travel in, that people that I talk to are concerned about the same thing that you're concerned with, but I get overwhelming feedback from the presentations that I do on channels like yours. People expressing solidarity with my statement that the people who compile the CPI shop somewhere differently from where I shop. I suspect that that's in fact the case. Now, we've benefited in the last 50 or 60 years from tremendous technological advances, which is to say that the cost of producing and distributing a lot of things that are essential to the way we live has gone down, which is wonderful. As an example, food in the average household budget has decreased from over 30% of household expenditure down to 14% of household expenditure, even while the work component in the food has gone up. In other words, when people go to grocery stores, they're buying solutions, they're buying meals. They're not buying raw food so much anymore. And that's been tremendously beneficial to society, to the extent, I don't know that it will, but to the extent that the deflation in food costs begins to subside, a very strange and very ugly thing happens to even the manufactured CPI, unless they decide to hedonistically adjust food, unless they decide that macaroni and cheese, prepared macaroni and cheese, represents a substantial qualitative improvement over buying macaroni and cheese. In other words, if macaroni and cheese is better than macaroni and cheese, and they begin to alter the denominator for CPI purchase around food, maybe for a while they can cause people to ignore the perniciousness of inflation. But I suspect that working families are seeing the results of inflation, and I hope I add in my own small way to this, in their property tax bill, in their income tax bill, in their gas tank, and in the sacks that they buy at the grocery.
Is there a path out for the Fed? I mean, they're talking taper and raising rates, but that leads to a market collapse, probably. If they let inflation run hot, that just leads to a different type of disaster. I mean, does the Fed really even have any choice here? Is it just they can't raise rates? They can't taper?
I think they can hope to manage it. They've done a very good job, I think, of managing the narrative. The investment community, and I think most of the voting class, actually believes that the big thinkers of the world can stick handle their way through any catastrophe that they see. My own belief is that the policy options available to them, particularly around liquidity, will lose their potency at some period of time. Will it happen this year or next year? Being honest with you, I have no earthly idea. It reminds me of somebody famous, I forget who it was, talking about how you go bankrupt. At first, very slowly, and then later, very rapidly. And to the extent that confidence begins to disappear in the Fed, to the extent, as an example, that and I'm not saying that this is going to happen, but to the extent that there was another black swan that caused another liquidity event to tighten up capital markets, I wonder about the ability of the Fed to maintain investor confidence or taxpayer confidence with another massive injection of liquidity.
You bring up black swan events. We had Archegos earlier in the year, and then we recently had another issue with the short squeeze in the 30-year Treasury bonds. So that's driving rates down. Do you see an instance where there's going to be some sort of counter move to that? Do you see perhaps there's going to be another black swan or more damage coming from these short squeezes with these hedge funds that will drive rates one way or the other?
I don't. I I mean, the nature of a black swan event is that it's one that most people don't know how to forecast. And if one occurs in the next while, my suspicion is that it will come out of left field. There's all kinds of candidates out there. The first candidate being simple arithmetic. The idea, listen, negative real interest rates are not a force of nature. They're a human construct. And if arithmetic reasserted itself over narrative, and if the markets took control of interest rates, that would be the biggest black swan in economic history. Right now, the arithmetic around the world's benchmark savings instrument, the one that you'd posted, the US 10-year Treasury, they're paying you 120 basis points in a savings instrument whose value is depreciating by 4.5% a year, which is to say that they're costing you 275 basis points a year. As Jim Grant describes it, this is return-free risk. Traditionally,
Return. Okay.
that's what he calls it, return-free risk. How natural is that? I mean, you have to pay to be a lender. This is truly insane. Traditionally, by traditionally, I mean over the last 60 or 70 years, the real interest rate on the US 10-year Treasury to the CPI stated rate of inflation has been positive, which is to say that there was a positive real yield, generally over 1%, sometimes 1.5%. So think about that. If the CPI stated rate of inflation, we'll make the math easy. Let's say it's 5%, okay? And we got to get 150 basis points positive to that. That would be 6.5%, up from 1.2%. But first of all, that would wreak havoc on the federal budget. Having the interest payable quadruple would be problematic. But that interest rate rise ripples through the rest of the economy. Traditionally, the 30-year mortgage rate is priced at a premium to the 10-year Treasury. So if the 10-year Treasury had to yield 6.5%, that would suggest that the 30-year mortgage rate would be 7.25, 7.3. Think what would happen to housing markets with a 7.3 30-year fixed. Think what would happen to the retail automobile market if the revolving credit facilities around car loans went from, say, 5.5 to 9 or 10. Think what would happen to corporate credit markets if the median junk bond yield went from 4.5 back to its traditional territory, 11 or 12. That would be a black swan that I honestly hope at age 68 I'm not around to witness.
So the Fed assets seem to be accelerating. They say 120 billion a month, which is just mind-blowing to me. But it actually is above that. And then someone pointed out, if you look at their language, it was not 120 billion a month, it was at least 120 billion a month. They recently changed that. But it seems to actually be accelerating in recent months. We've seen some weeks where the Fed's balance sheet has grown by 100 billion. Is all this taper talk? I mean, these guys in the past week, they've been coming out talking, oh, I think we may be able to taper as soon as October. It's just all just bullshit, isn't it? It's just, they're talking, right?
I think if they were tapering, that is to say, if they weren't doing yield management, that you'd see the US 10-year Treasury above 2.
Yeah.
I very seldom listen to what they say. I'm of the belief that the political class, to quote an old phrase, are lying whenever their lips are moving. I've also learned that they know a lot less than they think they know. When you asked me about the rate of inflation, what I told you as a credit analyst is I have no earthly idea. I think that the big thinkers actually think that they know. And I don't think that they do know. So in the first instance, I think they're pernicious liars. And in the second instance, I don't think they know anyway.
Yeah.
Which is, it's interesting, but it's a little scary.
Well, that leads to my next question is, you sort of led into it right there with your answer. Do you think the Fed officials are actually worried about inflation, or have they simply made the choice already that they're just going to let inflation go no matter what? I mean,
I think they're scared shitless.
Yeah.
I think that's a financial phrase. You learned that in third year.
Yeah.
I think that they rightly understand that they're between a rock and a hard place. If they do not continue with their current course, if they let interest rates go up, they have a circumstance where the class that elects them, or at least elects those who rule them, gets thrown out of their house, loses their job. And I suspect from their own point of view, lasting long enough to make it somebody else's problem is, from their point of view, a better outcome than dealing with the problem now.
You know, you look at the spending plans of Congress, 3.5 trillion from, that's the one where they're not even going to negotiate with the other side. And then they also have a bipartisan 500 billion that they're passing. I would think the Fed's, you know, you listen to all these plans they got, and that's on top of, we have a $3 trillion deficit already built in for this year with all the stimmies and everything. I'm getting heated, Rick, I'm sorry. But so I would think the Fed's got to increase Treasury bond buying with what's coming down the pipe right now. I mean, logic, and then another guy, Tavi Costa, who I'm sure you know, he actually had a chart up showing how much debt is coming due that needs to roll over in the next 12 months. With something like some ungodly number like 7 trillion has to roll also on top of all the new debt. And that's assuming that everyone whose debt is maturing, that they're going to roll and the Fed doesn't have to I mean, it's freaking insane, Rick. In what universe can the Fed, I think they got to accelerate and buy even more to keep this train rolling.
I suspect you're right. I mean, I can't extrapolate over the investment decisions of all of society. But
why not? That's why we have you here. I need you to give me, I come to you for these answers, Rick.
When they come to me and they say, okay, I'm going to pay you 1.2 in a currency that's depreciating by 4.5. In other words, if you give me money today, I'm going to give you back 35% less purchasing power in 5 years from now.
Sounds like a wonderful deal to me, right?
Yeah, I mean, this thing's insane. I mean, I understand that if you're a great big institution and you buy a US 10-year treasury at 1.2 and you use money that an arm of the Fed loaned you at 25 basis points, you get a 95 basis point net spread.
Mm-hmm.
I get that. It's just that they aren't lending me money at 25 basis points to buy the 1.2 yield on a US 10-year treasury. I don't get that spread, and most of your listeners don't get that spread either.
Yeah.
Until channels like yours succeed in explaining the arithmetic of debt and deficits and quantitative easing to the average American. The average American, I think, wants to abrogate control of their financial future to the big thinkers.
Mm-hmm.
They don't want to worry. They want to be cared for and protected. In other words, the sheep are absolutely determined to hire the wolves to guard the flock.
Mm-hmm.
And, you know, maybe that ends well. It normally hasn't.
Yeah, you know, I was just going to say, when you talk about housing affordability, I mean, hasn't the Fed lowering rates over all this time, these decades, actually driven the cost of real estate way higher?
That would be my argument.
Yeah.
It makes absolute sense if they're going to subsidize homeownership, given how much they steal from you as taxpayers. It makes absolute sense that you would avail yourself of the opportunity for free money. I mean, I believe the 30-year fixed rate right now is a gift from God.
Mm-hmm.
I don't advocate that people take money out of their houses and consume it, but all of the 30-year fixed money that you can get right now, provided that you do something intelligent with it, I just have the feeling that 10 years from now, that's going to feel like a real, true gift from God. If we have free market interest rates, it might be that the value of your collateral has fallen somewhat, but you have the money.
Mm-hmm.
The lender has the problem.
Yeah.
You know, I have one last question. We talked about the Fed buying assets. The Fed's buying bonds, correct?
Mm-hmm.
So when they're buying these bonds, basically, what was it? Risk without return?
Risk-free, return-free risk.
Return-free risk. Okay. So what do they do with them? Do they just sit and hold them?
Oh, it's better than that. They record the income, the interest that they receive from them as income. So it actually reduces the federal deficit.
Yeah.
Sorry, I can't help but laugh. This is so
Well, didn't
circular and
Japan?
Kafkaesque.
Japan has bought the Japan central bank. Everything is below zero. Essentially, they're refinancing the whole debt. So if the central bank owns 100% of all the sovereign debt at below 0%, hey, then servicing the debt's pretty freaking easy at that point. If you get everything below zero.
I mean, it makes perfect sense to me. If they could do that, why charge tax?
But don't they have to at some point sell these bonds?
They could probably issue new ones at maturity and keep the same Ponzi scheme in place.
They almost have to at some point,
as long as the market didn't give them an interim spanking.
Yeah. Well, you know, the Silversqueeze is sort of what got Wall Street Silver started, but I mean, all of us knew this wasn't, you know, the silver, it's a bigger macroeconomic problem. It's not a short-term issue like GameStop was or something like that.
Right.
And I mean, there was a small group of us that were like, well, this is like Silversqueeze. We need to be squeezing the, it's like, no, this is bigger than that. It's
right.
And it's not a short-term issue. We're looking at a generational problem.
Jim,
it doesn't go away short-term.
You know, we've talked on your show before about the real Silversqueeze. And the real Silversqueeze is in comics. The real Silversqueeze is that right now, precious metals and precious metals related securities comprise 0.5% of savings and investment assets in the United States by category. The 3-decade mean market share is 1.5%. So if the circumstance that we find ourselves in today with regards to quantitative easing, debt and deficits, negative real interest rates, manifest themselves into just a reversion to mean, demand for precious metals and precious metals related assets triple.
Yeah.
Now imagine the impact of a tripling of demand for precious metals throughout society.
Wow.
That is a Silversqueeze.
Rick, you have a website that you want to mention for ranking for our people. Could you mention that for us real quick?
I do, absolutely. I enjoy visiting with your audience, and to give them incentive to visit with me, if they go to a website, sprottusa.com/rankings, they can enter their natural resource holdings. Please, no pot stocks, please, no crypto, please, no technology, just natural resource companies. I'll rank them 1 to 10, 1 being best, 10 being worst. And if you mention charts, I'll include the Barron's Gold Mining Index, which is the best precious metals equity index I know of, not for technical analysis, but rather is an illustrative tool to talk about the sort of dynamics behind bull and bear markets. And I'll also include a 100-year commodity chart that talks about just how cheap the commodity subsector is relative to other asset classes going back 100 years. That's sprottusa.com/rankings.
Nice.
Sounds good. Well, Mr. Rick Rule, the legendary Rick Rule, thank you very much, sir. We'd love to. Oh, yeah. And don't. And I need a selfie, dude. I need a selfie of you.
I got to post it before I give you the selfie.
Well, of course. Yeah, post it somewhere.
That I actually defaced their defacement.
Yeah, I want evidence that you are doing that. Thank you very much, sir.
Okay, my pleasure. Thank you.
We appreciate your time.
Always
Take
a
care,
pleasure.
Rick.
Thank you.
Thank you.